what I thought I'd do today is look at the potential impact of Brexit. These are very much initial opinions, initial thoughts. Happy to hear any comments, and do stop me or ask questions as we go through. It's very early days in all of this process, and there's going to be an awful lot to think about, and I suspect we'll be back talking about Brexit and its potential impact for a number of years yet. We've talked a little bit about Fidelity, so I won't labour that point. Let's start with how we got here. On June the 23rd, the UK referendum, the voters voted to leave the European Union. And really the thing we need to ask ourselves, because this is going to feed down into the real estate market, is Brexit a cause of a problem, or is Brexit simply a symptom of a wider set of issues? And I suspect we got the answer to that yesterday with the election of Mr. Trump. We can no doubt take questions on that later. But really, what are the short-term and long-term implications for the UK and European Union, and how will this impact the real estate market? I'm going to try and touch on a few of those as we go through. What I've done is broken it up into 2 or 3 sections. One is the more obvious question, what's going to happen to the UK market? That's where the focus is. But I think it's very important that we don't just focus on the UK market. This is a two-way thing. The UK is the second largest economy in the European Union. It's also been one of the fastest growing for the last 20 years, and it's suddenly left. So there's an impact on both sides here. And then hopefully what we'll do is bring it down as well and look at it perhaps from the Swedish investor angle. What are the opportunities, but also now what happens to the risks if you want to leave Sweden at all? Or maybe you'll be very happy here, given what's going on out there with the storm. So let's start with the UK real estate investment market, and let's look at a few of the macro issues to begin with, and then how they feed down into the commercial real estate market. And really what I've tried to do here is highlight a few of the key ones. We're in what we call at the moment in the UK the phony war. What does that mean? It means that we don't really know who we're fighting, what's going on, or what's happening. All we know is that everybody's nervous, but nobody actually knows what Brexit means. As a lawyer friend of mine said, since the UK joined the European Union, there have been over 40,000 pieces of legislation affecting the UK. Every single one of those has to be unpicked. This is going to take some time. So the impact here really is what happens before we get the details of Brexit and the negotiations start. Currency is the big key in all of this, and to those of you who've been to any of my talks down the years, I'm a bit of obsessive about currency, because currency is very much at the root of all the volatility of the last 5-10 years. Also, what are the impacts for inflation? We haven't heard back from inflation for quite some time, but inflation is coming back, certainly coming back in the UK. And what are the impacts for GDP growth and then interest rates? And this is very, very interesting given now what's happening with Brexit. So let's look at currency. What this chart shows you is the long-term value of sterling versus the US dollar since '98, slightly random date, but they all start from an index of 1, and it shows you the relative value of the currency versus a basket of other currencies. And what you see immediately is what happened in June. Effectively, against the US dollar, the reserve currency in the world, sterling fell 20%. So that hit foreign investors very, very hard in commercial real estate markets. But it also meant UK asset prices were suddenly very, very cheap, if you could get comfortable with the risk. Unfortunately, US dollar investors suffered a double whammy. Normally when property prices fall, of course, you get the benefit of a rising yield on your balance sheet. Didn't happen this time. you got hit by the yield and the capital value. But interestingly enough, we're getting mixed messages on what's the true value of sterling. This is the big question for everyone. Outside of the European Union, what's sterling going to be worth? At the moment, the forward rates on the market on Bloomberg are showing that it's settling somewhere around 120 to 125 against the dollar. It had been trading traditionally at 155 to 160. So this is a long-term devaluation possibly, and that has implications for the UK and for people investing there. And some people are even talking, if Brexit is a hard Brexit, we could be talking about parity, so we could be talking about $1 to £1. My personal view is at the moment, 120 to 125 feels about right. And let's not forget, we're at the maximum point of risk at the moment. Everyone is pricing full risk into the markets. Why? Because we don't know what's going to happen. We don't have what Brexit means. We don't know whether it's going to be a hard Brexit, a soft Brexit, and what the impacts are. And of course, in the background, we have, following yesterday's election, we've got elections coming up in Italy, in Holland, and in France as well, all of which could throw some very big surprises up. Interest rates. This is an interesting one. Interest rates in the UK are 0.25% or lower, practically zero to all intents and purposes, and have been since the UK introduced QE back in 2009, 2010. It's very difficult to see, with the current problems, the Bank of England pushing up the interest rate. Now, the consensus seems to be that rates will stay on low. We'll come on to this with the ECB in a minute, until at least 2018, simply because there is so much economic uncertainty. But the interesting thing on interest rates is, normally low interest rates means we get a lot of debt into the markets. This cycle we've seen very little debt deployment. It's nearly all been equity. So where's the impact on real estate come from? Cheap interest rates have actually meant that weaker companies have stayed alive and that unemployment has stayed low. That's been the impact of low interest rates in the UK and increasingly in Germany as well. So interest rates we expect to stay lower while we figure out what Brexit means, simply because the government needs to keep the tax take and needs to keep people in employment. So we're in a low interest rate, lower for longer. And at the moment, GDP growth seems to have stayed positive. There were all sorts of Armageddon scenarios in August about what was going to happen to the UK economy. It's actually remained remarkably positive so far, but that's because we haven't really got to the negotiations yet. So we wait to see what's going to happen potentially in March, although that date is now getting pushed back. Some of you may know that the law lords in the UK have turned around and said that the government cannot enter into negotiations on Brexit until Parliament's voted on it, and that's going to cause a whole bunch of new problems. But we're getting mixed messages from the market. There's been some very big positives. There's a very big factory in the north of England where Nissan employs 7,000 people. Their exports account for 1.5% of all UK GDP exports. Their cars they export. They've just voted to, so they're going to stay, and they're actually building their next 2 lines of cars there, despite Brexit. So that was positive. We've seen the precedent of the Canada deal going through with the European Union, which provides quite an interesting model for the future of the UK's relationship with the EU. But on the negative side, the Canada deal also showed how difficult it is going to be to negotiate with the EU as a bloc when you've got very small groups like Wallonia and different people who can throw a spanner in the works. And equally, we don't know whether it's going to be a hard Brexit and everyone says, no, you're completely out, in which case we could see some GDP numbers that suddenly deteriorate quite rapidly. And the interesting thing, of course, in the UK compared to the European Union is that if you have a 20% drop in your currency and you're a big importer like the UK is, you get inflation. And that's what we're seeing now. And we're now talking about inflation in the UK spiking at 4 or 5% next year. So what does the bank do? Do they raise interest rates? What's their priority? To keep interest rates low or to kill off inflation? And the argument at the moment from the central bank governor, Mark Carney, is that the inflation is not structural. It's to do with this currency adjustment, so they're not going to raise interest rates. But of course that has an impact, for instance, on rental values. It begins to have an impact on if we have a sustained period in inflation. But more importantly, it means that 10-year bond yields are likely to rise. What does that mean? If we see a rise in bond yields, that begins to put pressure on property prices, because a lot of people invest relative to bond rates, particularly institutional investors. So if bond yields start to rise, will we see pressure on commercial property prices in central London? We may well do. So what's the actual impact on the market been? Well, the initial price correction is stabilised, but you see all the dots for now, because we don't really know what the shape of all this is going to be. What this chart shows you is the MSCI IPD All Property Monthly Index Total Return since 1986. And you can see, so this is since 2006 actually, we've truncated it. And you can see the line moving around all over the place. When Brexit was announced in June, you could see what happened to total returns. Capital values fell overnight, around 7% in the city and West End of London, and about 5% across the UK. As everyone said, oh, it's all falling apart. Funnily enough, the world didn't end. What happened? That actually the bond market and the equity markets went up. And you can't have property falling while bonds and equities rise. Markets don't operate in that way. There tends to be a correlation of all markets move in sync with one another. We had a number of open-ended funds that closed for business with outflows, but actually since they've reopened, we've seen inflows into the sector. Capital values have actually grown again, slightly from a very small bit, but actually total returns have gone positive again. And we see for the remainder of the year and the first quarter of next year, property capital values remaining relatively stable. There's a lot of money still in there. If you're a sterling investor, it's a very expensive time to be sending currency to Sweden or to Germany or elsewhere, so the money's staying at home and that's supporting values. And the interesting thing is, despite all the economic uncertainty, rents continue to grow across the UK, across all sectors of the property market. And the reason for this is, weight of money has been driving pricing, but market fundamentals are supporting rental growth. We talked a little bit about low interest rates supporting the occupier and consumer spending. It's held up very, very well, so we're not seeing a fall-off in spending in the high street. We're seeing a lot of occupiers and businesses benefiting from low interest rate environment. But the biggest single thing driving the UK market, and I know it's a factor here, and particularly in Germany, is the fact that there is very little construction. There's very little new supply coming through into the markets. And the reason for that is in the last crash, if you think about what happened in the credit crunch, in good old-fashioned days, when we used to understand property cycles, what we used to do was get the banks to lend to developers. Developers would build too much, rents would collapse, property developers would go bust, banks would go bust, and we'd all say, we'll never do this again. And then about 8 years later, we'd do it again. The last cycle didn't happen that way. What happened was the banks lent directly to the investors. They didn't put it into development. Why? Because yields were higher than interest rates, so they simply had to buy a building with a tenant in it on day one. And they took the money, the difference between the yield and the interest rate, and put it in their back pocket. That was the credit crunch. What it meant was very little across Western Europe has gone into the development of new supply. And we're seeing this rising rental values in many, many markets now. In the UK, for instance, the replacement rate, i.e. the amount being built relative to the stock of office space, is at its lowest level since 1979, for those of you who can remember Margaret Thatcher. So there's a big supply problem. The occupier market remains strong. Rental growth is slowing, but it's still quite positive at 2 to 3%. These are quite aggressive numbers still coming through. And remember, it takes a year or two for these rises to feed through into the income returns for investors. But transaction levels have fallen. Activity has fallen off. You can see what happened. But the interesting point here is that Brexit wasn't the cause initially. What you can see is actually the trend in investment purchases in the UK has been declining for nearly 18 months anyway. It had been slowing long before Brexit. Brexit literally delivered the sucker punch and accelerated the process. And the biggest sector taking the hit on the right here was the office market, where you've seen a 40% fall in investment turnover. And that's primarily because of uncertainties around Brexit and the City of London. How much money will be left? Will people have to move out and go inside the Eurozone, etc., for business? But I wouldn't overplay the impact of Brexit. As I said, this is a trend, an established cyclical trend that Brexit has accelerated. But actually, when you look at these numbers, they're still not, they're still relatively healthy compared to some cycles we've been through in the past. But the market is definitely slowing. The interesting thing, as you saw, though, is pricing is not changing. So the real estate performance outlook for the UK does look challenging compared to continental Europe, and we'll come on to that in a second. The first thing is we're talking about very modest returns now. We're going to be talking about returns between 5 and 6% over the next 5 years, which means there's very little capital growth in there. There's a bit of income coming from your rents, rental growth, but it's all about yield from here on in. So investment strategies are increasingly looking at yield-driven investment strategies. This year, we're talking about the IPD index delivering a total return of around 0 to 1-2%. So there's very little capital growth in here. The income return on that, 5.5%. So you're netting off those falls earlier in the year against this income return. We think capital values will stay stable till around March or whenever the negotiations start. Once we begin to understand the nature of the negotiations and how hard it's going to be or easy, then people will start pricing that into capital values. But rental values will remain positive while market fundamentals remain positive. So if you are looking at the UK market and you're a real risk junkie, It's going to be volatile. It's going to be lower returns. We're in a low growth environment. So you should be looking at your 5-year returns starting at the top end with a 6 to a 7 for a core plus strategy. Okay, these are far more modest returns than we've just seen through the recent cycle. So everyone's investment strategies are really going to have to focus on income. And so in the absence of capital growth, real estate starts to behave like a bond. It becomes a fixed income tool or part of people's investment portfolio. And given the uncertainties around Brexit, we think this is how investors should be treating it if they want to buy it. And really there's two things to focus on. Keeping the tenants you've got, so understanding what they do, what businesses are they in. Are they in the types of businesses that are likely to get hit by Brexit? Okay, financial services is one. How relatable is the asset? And then on the income side, how good are the assets? Do you really want shorter leases at this point in the market? And what are the demand-supply factors? But it's really about preservation of income and growth of income, which will be incremental and relatively small, which is why your returns are going to be lower. So short term, the UK is definitely going to take a cold shower compared to continental Europe on the fallout from Brexit in the real estate market. So let's switch our attention over to continental Europe and the Eurozone. For the purposes of this, I'm focusing on what I call the core Eurozone, and I am focusing in as a currency play, and we'll deal with the Nordic markets and then Eastern Europe separately, perhaps. And I'm talking really here about France, Germany and the Benelux, the engine room of the European Union in terms of the economy and size of the economy. And we're seeing a very, very different picture here, very different picture. We're seeing another strong year coming through in the core Eurozone. We're seeing capital values supercharged in Germany. It's slowed a little bit in France. We're seeing very, very aggressive growth in pricing in Belgium and the Netherlands. And the reason for this is weight of capital. Okay? There is a huge amount of capital looking for yield and not wanting to take risk. It's safe haven investing with a yield attached to it. And Germany fits the bill very, very well for very particular reasons I will come on to in just a minute. Okay. So for 2016, we're expecting the INREV benchmark indices, for those of you who like their indices, to come in at circa 11 to 12% for this year on core plus strategies. Those are ungeared returns. And around 8 to 10 next year. So, I mean, these are still quite aggressive numbers. When you're talking about markets where there's zero inflation, bond yields are negative, equity returns are under pressure, these are big returns, relatively. Expected income returns from real estate in the core Eurozone, 4.5%, but that is coming under pressure because property prices are being driven through the roof in some of these markets at the moment. And it's this yield compression, or weight of money, targeting Germany specifically, but also Paris and the Benelux. The interesting thing is, though, we're not seeing much evidence of rental growth in the European markets in the same way. We're seeing pockets of it, but not the same widespread rental growth we've seen in the UK. So for a 5-year view at the moment, we're looking at the Eurozone kicking out somewhere around 8 to 9%. But beyond 2017, a lot of the things we talked about in the UK are going to start coming into play. The capital growth will slow as investors invest their money, and the focus will shift to income beyond 2018. But low interest rates mean something very, very different in a Brexit environment to Europe, okay? In Europe, we have quantitative easing, which used to be called printing money. But we've got a nice name for it now. It means interest rates are going to stay lower for longer, okay? And it means two things for the property market. It means interest rates cannot rise while you've got QE, all right? You cannot give money away and then charge for it. You either give it away or you charge for it. So long as we're printing money at the rate of 80 billion a month and pumping it into the markets, effectively what the ECB is doing is putting a price guarantee in the asset market. They're saying asset values cannot fall. Okay? We're going to keep the market pumped. And we know at the moment that we're now talking about QE running as long as 2018-19. It's being extended constantly and pushed out. Why? Because of very low growth in parts of the Eurozone, southern Europe. And QE is an implicit guarantee of asset prices. This is exactly what the UK and the US did with QE. You boost asset prices, people can leverage that and invest into the economy. So we know that interest rates can't rise. This is going to keep downward pressure on government bond yields. You know, they've moved around a little bit, but they're practically yielding nothing. So where are pension schemes getting their money from right now? they're looking to real estate and other alternatives. They have to. There is nowhere else for them to go to get a return. Okay? It's going to increase the use of debt, although weirdly not in the levels we've seen in the past. Okay? But what it means is that European rates are probably going to stay flat till 2020, unless there's a major, major recovery across the whole zone, and that doesn't look likely given what's going on out there at the moment. It's a cheap currency, the euro, for US dollar investors. It's still down 9% on a long term since 98. It doesn't offer anything like the spread that sterling does. Okay, but what we've got to be very careful of when we're dealing with the euro is the fact that the euro isn't a single currency. The bond market tells us that. A German euro is worth more than a Portuguese euro. That's what the bond market yields tell us. Why do I say that? Because the productivity levels and economies supporting a Portuguese euro are very, very different to a German euro. And this is the fundamental stress that's causing the problems within the Eurozone and the whole euro project right now. And I think we're very lucky to be safely out of it with the krona. Because things are going to get nasty in here again this year, for remote reasons we'll come on to in a minute. But what we have to realise is that there is a spread. Effectively, German assets in euro terms are undervalued. Southern European assets are overvalued. Okay? And I'll explain why. But what's really drawing people in at the moment is this yield spread. Okay? Property in the Eurozone is providing an attractive yield on an absolute and relative basis. And what I've done here is simply put the yields available from cash, bonds, equities, and the Eurozone core real estate. And you can see the scale. Even at prime real estate, offering sub 4%, still looks attractive, particularly versus cash and government bonds. And this is pulling in a huge amount of money to the core Eurozone and driving pricing through the roof. Traditionally, this spread was 100 to 150 basis points. Today it's nearly 400. And that's a huge spread. And what it's doing is it's pricing liquidity risk into the market. At some point, either these have to rise or these keep coming down. And what it looks like at the moment, because remember QE and low interest rates, these aren't going anywhere. So these are going to keep coming down. Because you can still make money here without getting close to the yields that bonds are delivering. So you're still going to see upward pressure on pricing, downward pressure on yields in continental European property markets, simply because there's nowhere else for the money to go. Is it sensible? Who knows? Somebody said to me, is something overpriced? Nothing is ever overpriced. Price is simply a function of what someone is willing to pay for something. Okay? Maybe we're going to an environment for the next few years where prime real estate in the core safe haven markets, including Stockholm here, all starts with a 3. It's feasible. That is your threshold. It's saying that's sensible. It's saying it's feasible. And you've still got the same issue in continental Europe, positive market fundamentals. QE and low interest rates are driving letting demand. These are the Jones Lang LaSalle numbers, including forecasts on lettings. And the bottom one is office completions. And what the line there is showing you is that the amount of office supply coming through is at the same level as it was in 1980. I mean, it's just very, very little getting built across the market. And this is creating a perfect storm, along with the macroeconomics, to push pricing further and further up in continental Europe. And that's exactly what's been happening. What this shows us is the value of quarterly investment purchases in billions of euros. And I've put the UK in there as a relative, and the core Eurozone is the dark blue, and the rest of Europe is grey. Now, what you can see is the UK fell off a cliff in terms of investment purchases, but so did the core Eurozone. So that said to us, oh, hang on a minute, investors are scared. What we discovered when we started speaking to investors is that they're not scared, it's that they can't find anything to buy. It's very, very difficult sourcing stock. I'll give you an example. 4 years ago, we were doing deals in Germany where we were the only bidder. Only last month, we were involved in a deal in a very much second-tier sitter in Germany where there were 17 other bidders for the asset. In that environment, it's very, very difficult to get investment purchases away. So while the UK is falling away because people are nervous about what's happening with Brexit, what we're seeing in Germany is more and more investors trying to get money away, and that's causing a bottleneck in the market at the moment. People just simply cannot get their cash deployed. And we think that this competition is going to go over into next year as well. And if you look at the amount of capital targeting the markets from all over the world, I mean, it's at levels we've never ever seen before. And it's coming from places you wouldn't believe. I mean, we were outbid on a deal by a Taiwanese insurance company in a secondary German city. How does that work? I'd never even heard of these guys. They were aggressive. So the key messages on the Eurozone is political uncertainty and currency risk are the key challenges, okay? You remember, it's a two-way thing. We know that the UK is going to have a bad time short-term, whatever happens, because there's so much uncertainty and markets don't like it. Political uncertainty cuts the other way, though. What remains in the European Union? It's the equivalent of the US having California ripped out of it in terms of GDP. What happens next? So we're still seeing very positive growth by Eurozone standards, 1.5% over the next couple of years, and that's obviously very loaded towards Germany and across Europe to the Nordics and to Germany and the core Eurozone, but the South is still suffering. And I'm going to loop back to that in just one moment because it's very, very important if any of you are looking to invest into the Eurozone that you get very, very clever about how and why you do it. Okay, we're now in a period of prolonged low growth. With low interest rates, yields are low, growth is low. It's going to be very, very difficult to make high returns out of any asset class. And what we're seeing effectively is real estate drift into line with other asset classes. Okay. On the investment market, the positive fundamentals remain. There's very little debt in the market, very little supply, and vacancy levels are now at what we call structural levels, i.e. they're so low that you're beginning to see people look at development opportunities again. But there's still not a lot of capital willing to go out and do speculative development. So it's going to be weight of capital driving the market, and it's distorting the shape of the market. It's making this property cycle artificially long because there's so much cash in the pipeline. We don't really understand what happens beyond that. So really, at the moment, it's the core strategies and probably core plus strategies where you're looking at best assets in second-tier markets, etc., are benefiting. People don't want to go too far out on the risk curve, but they're focusing a lot of money in a few places, and that's causing this huge distortion in pricing. But investing into European real estate is not without its risks. And looking at Europe as a single market, as I keep saying to one of my American friends, is not a sensible thing. I said looking at the difference between Porto and Stockholm is like looking at the difference between Boston and Mexico City. Okay, these are just very, very different places. And if you think about the structure of the Swedish economy and the sophistication of it versus Greece, and yet they're all lumped into a single market. There's very different things going on, but there's some very, very big fundamental problems coming towards the European Union economy, which are going to feed through into property. And these are them. The first is the threat of a future currency crisis, okay? Everyone said, oh, we've done that, we've solved it. No. We come back to my point that a German euro is worth more than a Portuguese euro. We're all locked into a single currency, okay? In the old days, if your economy was failing, it was pretty easy. You devalued your currency. Your wages went down, your unit labour costs went down, your asset values in the real estate market went down. Your rents went down. And then you got some growth, you got some inflation, and you came back. And you were able to compete against the more productive economies. You can't do that in a single economy with a single currency. So what happens? In Portugal, in Greece, in Spain, in Italy, if you can't devalue your currency, you have to devalue your salaries, you have to devalue your asset prices, you have to cut wages, and you have to effectively devalue by deflating your economy. And that's exactly what's been happening in the South. We're seeing huge deflation in asset prices, in salaries, and unit labour costs. In some parts of Spain, it's come down by 30% across the board. The problem with that is, it begins to impact property disproportionately. Why? Because property is a physical asset, and more importantly, in continental Europe, a lot of leases are linked to inflation. How do you grow income in a deflationary environment with an index lease? That goes against the laws of physics. Okay, that's not going to happen. So the objective of the single currency was great. We're going to have a single currency, it would reduce costs, centralised monetary policy, standardised pricing. This was all going to be brilliant. But the outcome was there's a significant divergence between the strength of the economies within that block. Okay? The weaker ones can't revalue, and it crystallized the economic inequalities at the day you set the euro price. And what's happening is you are hollowing out the periphery states. They cannot compete. They're losing investment, they're losing asset values, and what's happening in terms of real estate is we're seeing huge deflationary pressures, falling asset, a fracture really between the core and the periphery. So the core, Germany and the Nordics, is booming, the fringe is withering. And this is dangerous because in an illiquid asset class like real estate, where you've got no rental growth, you're asking investors to come into markets like Italy and Spain, take a liquidity problem, potentially a currency problem, and no rental growth. Sounds like a great investment. And there's a second and final part to this. Quantitative easing. Quantitative easing is causing huge problems for the European Union real estate market, and it's linked to the currency. Everyone said QE is brilliant because it worked in the US and the UK. Yeah, both those economies have a single currency backed by a central bank which has the taxpayer standing behind it. The ECB doesn't. The ECB does not have a mandate to raise taxes. Okay? Big problem. So QE theory was in bonds, they invest it, and hurrah, everything gets pumped up. What happened in reality was lots of people printed money, and then when we got to this bit, if I was in Southern Europe, I thought, well, am I going to invest this in real estate in Lisbon at 5.5%, or I could put it into Germany and buy a 10-year lease to DHL at 4%. I know what I'm going to do. I'm going to export my capital to the core. So what we've seen is pension funds, investors taking money from the periphery and pushing it into the core. Why? Let's look at the scenarios. If there's a meltdown in the currency markets, well, let's say there isn't a meltdown, when all things are solved, I'm left with a 4% yield in Germany. It's pretty good. I like that. What happens if the euro partially cracks and the weaker countries fall out? What happens to the remaining euro? It goes up in value. So I win. I'm holding it in Germany. What happens in the Armageddon scenario? The euro snaps completely. What am I left holding? Well, I've got Deutschmarks. Have a guess what they're going to be worth? A lot. So there's a huge insurance scam going on here. People are pumping their money into Germany and the core. And this is distorting QE. And what it's doing is driving values up in the core and depressing them in the fringes. And this is the next big problem linked with Brexit. Okay, all of this is bound up together. So one has to be very, very careful. What it does mean is, if you want to get involved in commercial real estate investment, focus on the core. Okay, follow the money, because that is where you've got certainty of return. And more importantly, in the core, you've got the German taxpayer to bail you out, and everyone likes that. So from the Swedish perspective looking out, it looks pretty stormy out there. You know, you've got a great market here, you've got a booming economy, you've got a very, very strong... but in times of uncertainty, that's when you make your money. It's when you get paid as investors to go out and find opportunity. There is opportunity out there. It's all about your appetite for risk. UK assets look really, really cheap, but they look cheap for a reason. We don't know what's going to happen yet. So if you are a risk junkie, fixed assets in the UK could be a very interesting play for you if you can get comfortable that 120, 125 versus the dollar is about the right price for sterling. Because you can be buying some quite decent assets. There's a lot of people willing to sell out. Okay. And let's not forget, property values have not fallen in the UK in domestic terms. They've only fallen in international currency terms. Unfortunately, Krona investors missed out on, for those who didn't go abroad, missed out on a fantastic opportunity earlier on in this decade, where the Krona was just soaring away from the rest of the markets, and exporting capital was bringing you enormous returns. Having said that, the Krona is still a strong currency. So there's attractive income returns available for Swedish investors in the core Eurozone and the UK. I would challenge whether there's attractive investments available in Southern Europe because of the risks to the income stream there. You're going to see further capital growth in the core Eurozone. You're not going to see much in the UK, okay? That's a very different play. That's an income play. So you're going to see more capital growth in the core Eurozone while we've got QE and low interest rates, because the German taxpayer is guaranteeing your bet. And what we're going to see is positive fundamentals. But what you've got to do is get real on your expected returns. Okay, so it's a case of what can I get at home? How much diversification do I need to go outside? Do I need to diversify and leave Sweden? What additional return? Is a return in the core Eurozone of 10 to 12% in the next year or two sufficient to get me to leave and get on that plane and Arlanda and fly over there and have a look, or not? Because your domestic market certainly looks fully priced here, particularly the residential market. Looks like London. You've still got an attractive yield profile in continental Europe and increasingly in the UK, but again, it's how much are you willing to pay for it versus what you can get here in Sweden. But of course, the main benefit for a lot of investors, they're simply looking to diversify their investment book into a larger and liquid market. And it's not without risks. You know, your market may not be so expensive on a risk-adjusted basis, particularly against a market like the UK. So, you know, keeping capital at home could make a lot of sense for you depending on that risk profile. Whatever happens, things are going to be volatile, all right? You just have to live with that. Everything's going to be volatile, not just because of Brexit, but because we've got the election yesterday. We are going to have problems with the euro currency next year, okay? And it's this currency volatility that runs through everything. You've really got to get very comfortable with where you're at with the currencies that you're going into. And I would seriously suggest that if you're taking positions in direct real estate, you do it on a currency-by-currency basis. Don't mix and match sterling with euros, with krona, with US dollars, because there's going to be huge movements between all of those over the next 12, 18 months. So conclusion, I think we can safely say that looking back over what's happening in the markets, Brexit is not a symptom, it's a symptom, it's not a cause. Brexit really was voters turning around and saying, we don't understand what the European Union is for. Is it a superstate or is it a trading bloc? Tell us, let's have a vote on it. And they turned around and walked away. I have to say here, I'll declare my hand and say I voted to stay in, but I knew a lot of people who didn't. I was very surprised. The short-term impact of Brexit is going to be bigger on the UK. Why? Because that's where the focus is, and it's the UK that's going to have to restructure. But I'm also going to make an argument that the UK leaving the European Union causes very big problems long-term for the European Union. This isn't a win-lose. This is a lose-lose in terms of volatility for both sides. Okay? Because we're producing, you know, what's happening? You're losing the UK. Next year, I think you get Albania and Moldova. You know, you've got to start thinking about who's in, who's paying for all of this, where's the money going to come from? So the risks at the moment are largely political, and that's very difficult for real estate investors, because the one thing we know about politicians is they change their mind all the time. So the first thing we've all got to find out is from next year, what does Brexit actually mean? And then what the impact on the currency is going to be. And then we can really start making some investment decisions, particularly as regards the UK market. Luckily, the core Eurozone is slightly out of that for the reasons I outlined. So Brexit really, in terms of real estate markets, has accelerated in existing trends. It hasn't necessarily changed them. It speeded up the slowdown, if you can say that, in the UK market. But what it has done is poured a lot more money into the core Eurozone. It's lengthened the investment cycle, and it means that continental Europe is going to outperform the UK over the next few years as an investment location. I think from a Swedish perspective, a lot of people see Sweden as a safe haven market. Putting the currency piece on the side, they see Sweden as a very safe haven, if expensive market. So one of the difficulties, of course, is it's not a very big market, and a lot of these guys are looking to move a lot of money very, very quickly, and it's a very competitive market with a lot of big domestic players. So overall, in all the continental European markets, expect yields to tighten even further. I know it sounds crazy, but they're going to unless something fundamental changes. Okay. So investor focus for the next few years, you've really got to start thinking about these income and income structures, because while we've got a bit more gas in the tank on price movements, the bulk of your return over the next medium term is going to come from yield in property. Sorry, that was a huge canter through hundreds of things. I'm happy to take any questions.
Well, I have a question.
Far away.
You talked about Sweden as a safe haven. Is there such a thing as a safe haven in the scenarios that you're describing? I mean, the peripheral Eurozone, and aren't Sweden one of the peripheral Eurozones in the Eurozone?
No, because Sweden isn't subject, with a floating currency, it's not subject to the problems. It can adjust its relative value. I mean, the currency is essentially your shop window onto a country. Sweden isn't harnessed to the euro in the same way. Its currency can float, as you saw. And secondly, the Swedish economy is structured in a very strong way. The problem with Southern Europe is, what exports and goods and services can Portugal and Greece supply on the world market? Sweden has leaders in technology, in banking and finance, in engineering. I mean, there's so many markets and things that Sweden is a leader or a big player in the global markets. It's a very, very sophisticated market. So in a sense, it's strong. Its problem from a property investment perspective is that there's already a lot of investors here. Pricing is already expensive. And as a foreign investor coming in, you're late to the party. It's kind of midnight. Most of the good booze is gone. And you're hanging around. Does that make sense? It's not peripheral in the sense that Southern European economies are. It's purely a function of size and where it is. But from an economic viewpoint, it's very strong.
Yeah. What can we do to stay competitive if, as you say, it's late night and all the good booze are gone?
In a sense, I think you'll stay competitive by virtue of the fact that your economy is very stable and diversified. I mean, you're definitely on the kind of German side of the economic fracture. If you were to draw a line through Europe, there's a group of countries on one side which is strong economically, which, irrespective of what happens, will do well. I think you just keep doing what you're doing, which is open market, high degree of transparency, good legal system, excellent brokerage and transaction, and the fact that you're buying product that holds its value, and there isn't a ton of risk here compared to other parts of the market. So it's really, just keep paddling.
Keep paddling. Yeah, right. Do you have any questions from the audience?
I can have one. You were talking about construction, and there is very limited construction in London going on, office and retail. But when you come to apartments and residential, that's not true. That's a lot of construction going on, isn't it?
Yeah, sorry, I should think this is very much commercial property.
Mm.
In London, there has been a lot of residential, but it's not really impacted mass market pricing because it tends to have been quite high-end apartments which have nearly all been sold to foreign investors and are out of the market. We have a really big problem in central London now with huge areas of high-end apartments which are empty.
Mm.
And they're just held as, well, I'll be careful what I say here. They're held so people can have a real asset for their money. There has been more residential development, and I know it's been a big issue here in Stockholm, the residential market. We don't tend to include residential in this because from an institutional viewpoint, I know it's quite popular here in Sweden. Generally, most of the big funds separate out their residential exposure from their commercial because the drivers to the market are very different. It tends to be gearing driven as opposed to weight of capital and equity driven. There's sort of different pricing dynamics within it. And that's why I wasn't really referring to it in these. But yes, there are some, but we're still seeing real estate asset price rises even in the residential sector. I mean, they're not what they were 2-3 years ago. They're still going up. Somebody said the thing with land is they don't make it anymore. So everyone wants peace.
Matt, I have a question. You talked a little bit about inflation risk in UK.
Yeah.
What do you think about the core Eurozone and inflation risk in long term? How it can affect it? Do you think it can maybe start in UK and then inflation can start rising in core Euro as well?
I think it depends on what your structural inflation. So we had rising wages, we had rising prices on the high street and input costs, then we might have a problem. Mm-hmm. The reason we're seeing inflation, I suspect, in the UK is because we've seen a fall in the value of sterling. So importing the components to manufacture things, importing oil and foodstuffs. The UK has to import everything. It's a huge entrepot.
Mm.
That's really what's forcing the inflation because, in a sense, you've got to make back up that lost 20%, so the consumer has to pay. Will we see that move over to the... No, I think simply because, we've had... How long have we had QE for now? We haven't seen any side of inflation at all. It's very difficult because although you've got latent inflation, arguably in Germany and France, maybe here, you've got huge deflationary pressures in other parts of Europe where you've still got falling wages, you've still got other things. That's why I get very nervous when I see the Eurostat figures saying inflation in the European Union is X. Don't look at that, look at the country level ones, because they're all moving in different directions. And it's still negative in most of the south. So I don't think you need to worry about that too much. And it's probably a slight criticism of the European, of all the central banks. Like all good generals, they fight the last war. Everyone's still paranoid about inflation, but we haven't had a problem with inflation for 20 years. We've got bigger problems than inflation right now. We've got growth. We've got to get back into the economy. So I don't see inflation being a big problem for the foreseeable future anyway.
Looking at the total returns for Sweden, normally we can look at the UK market and say like lagging 1 year or something to the Swedish total return. Do you think it's going to change now with the Brexit? Is it the same pattern? Will it continue?
That's a tough question. Thanks for that. The UK is an odd outlier in the sense that the UK economy is driven very much by global capital flows, and I think one of the structural problems and why Brexit occurred in the UK and not somewhere else is that I don't think the UK has ever been a comfortable European because of the nature of its economy. It's far more tied to other parts of the world still and capital flows that come through it. I mean, you'll know that if you walk around in London, all the languages and all the different banks and people doing business there. It's certainly not the cycle out this time, because I think Sweden's being dragged by what's happening in the Eurozone, and the UK has decided to shoot itself in the foot and go off over there for a minute. Is the European economy and the UK economy going to disengage? No, of course not. I mean, the amount of cross-border trade and everything is vast, and this is going to be right at the basis of the Brexit negotiation. How much pain do we all want? We can have a really painful divorce, or we can decide that we're going to go to mediation and try and work through it. I mean, I saw a stat last week where Germany's trade balance with the UK was 63 billion positive last year. Now, I don't think German exporters are going to be that keen on a hard Brexit. They might be politically, but... So I suspect what we're seeing is a temporary distortion while the UK redefines its cycle. Outside of the European Union, I'm not sure it will make a huge long-term difference, because I think the things that drive particularly the London market tend to be linked to global capital flows, and therefore it will carry on doing what it normally does. The difference may be that there'll be slightly less European clearing business and slightly more hedge funds, or do you know what I mean? There'll be tweaks around the edges as to what goes on in London. Does that give you some idea? It's about the best as I can do.
Let's talk about the elephant in the room then. Mr. Trump.
Oh.
How about Mr. Trump? What will be the effects, if any, do you see? He's talked about, for instance, increasing trade duties and trade tariffs. How do you foresee the US election with Mr. Trump in charge influencing the European market? That's an easy question.
24 hours to think about it. Many years ago, I lived in Hong Kong, and there was a famous interview where an American journalist asked Xu Enlai, who at the time was a very senior Chinese politician, about what the impact of the French Revolution was, and he said it was too early to tell, which I thought was quite a good Chinese response. They take a very long-term view on things. Coming around to your... First and foremost, if any of you have ever been to London, you'll have probably seen all those things that are always printed. It just says, keep calm and carry on. I think there's a degree of that at the moment. He says a lot. But actually, from a European perspective, the role of an American president is quite tied up. You can't do a lot. I mean, you've seen that with Obama. He had a whole slew of things he wanted to get through. There's a lot of checks and balances in the system. And I know the Republicans have got control of both houses as well, but there's a lot of anti-Trump Republicans as well. This sort of old-school Republicans. It's undoubtedly true that we're moving to a phase of more protectionism and populism, both in the UK, in the US. The natural impact of that is it could potentially hit markets that are very open to global trade. And Sweden is one. Sweden is a big global trader. It's relative to its GDP. You import and export a lot, just like the UK does and like the Netherlands does. The Americans, it doesn't impact as much, because the Americans actually only import and export about 15-16% of their GDP. They can pull the drawbridge up and stay there. I suspect the reality of realpolitik will come into this. There's too much American money around the world in other places for him to pull the drawbridge up. You know, where do Apple manufacture? They don't manufacture in Silicon Valley. It's all done in Shenzhen. So I suspect once the rhetoric's died down, we'll see what he's up to. But I do think we have to be slightly worried that there are going to be, should we say, or less enthusiasm for global trade than there has been perhaps in the last 20 years, and that does worry me. Because you only have to look around the world, and I know it's been tough, but the liberalisation of trade in the last 30 years, I mean, I lived in Asia for a long time, has lifted a huge number of people out of poverty and produced a huge amount of stability and wealth in some places, a lot of places, including China. So anything that knocks that, I think, has got to be a negative from him. But let's see. Keep calm and carry on.